Hi, this is Tom Essaye from Money and Markets TV. You should know by now that trading the headlines is a sucker's game. On one hand, overreaction to negative news could drive your positions down. But on the other hand, overreaction to positive news could give them an artificial boost and cause them to crash even harder when the real news comes out, or when the next batch of headlines isn't as positive as the last. Unfortunately, a lot of investors haven't gotten that memo and still drive stocks up or down based on what they think the day's headlines mean. Take last week's January employment report, for example. It showed that the U.S. economy added 243,000 jobs, much better than the 135,000 expected. In addition, the unemployment rate fell from 8.5% to 8.3%. Clearly, these are positive numbers, and the market reacted accordingly. The Dow rose over 150 points, hitting its highest level since May of 2008. But a look behind the headlines showed that the employment situation may not be quite as good as the market believed it to be. Within the report, there's a gauge of the average hourly work week, which is a solid leading indicator. When businesses begin to pick up, managers work their current employees for longer hours rather than immediately hiring new workers. Only after the new business becomes a sustained trend do managers hire new workers. So, a rise in the average hourly work week tends to indicate an improvement in the job market. But in the latest report, the number was unchanged. The employment rate for January may also be misleading. The official number is called the U3 rate, which only counts people who are actively looking for work. People who have given up their job searches aren't counted. For that reason, a better number to look at is the U6 unemployment rate. It also includes people who are underemployed or not working as much as they want to be, as well as people who are marginally attached to the labor force, meaning that they have quit looking. The U6 is a much better indicator of true unemployment, and while it has been improving recently, it still stands at around 15%, much higher than the official 8.3%. The point is that it's important to look beyond the media-reported headline numbers to see if the internals of a given report accurately reflect the economic reality, and if the market reaction is appropriate for that reality. The way I see it, the employment picture isn't as good as the headline numbers made it seem. So the market's euphoric reaction to the data may be overdone, and we could soon see a pullback. A discrepancy like this can present lower-risk contrarian investment opportunities for savvy investors. Those are exactly the type of opportunities that I'm helping subscribers to find in my $1 million contrarian portfolio each week. I'm Tom Essaye from Money and Markets TV, and thanks for watching.